Hey, Daniel here. Imagine a countdown that quietly cuts Bitcoin's new supply in half while the world keeps trading as if nothing changed. That single switch has powered some of the most dramatic price cycles in crypto. But why does it work? And what is the part almost nobody explains that could flip the script next time? First, the mechanics. Bitcoin pays miners new coins for securing the network. Roughly every 4 years, the protocol halves that reward, reducing fresh daily issuance. As Satoshi Nakamoto noted, the root problem with conventional money is the trust required to keep it from being debased. Bitcoin removes that trust by automating scarcity. Halving is the feature that enforces it. Now for what markets feel before they understand. Halving does not magically create buyers. It changes the flow of coins leaving miners and hitting exchanges. When new supply drops while demand stays the same, price tends to rise. That is basic microeconomics. But here is the twist you probably have not heard. The first move is not only about scarcity, it is about cash flow stress. Miners are businesses with energy bills. Many pre-sell part of future production or borrow against machines. Around a halving, the number of coins they receive per block is cut even though costs barely change. If price does not adjust fast enough, weaker miners shut down. Hash rate dips, difficulty retargets lower, and surviving miners gain share. This brief shakeout can push extra selling as stressed operators liquidate reserves, creating a fake-out drop before momentum returns. Fees matter too. When block rewards shrink, transaction fees become a bigger slice of miner income. In periods of heavy on-chain activity, fees offset the cut and reduce sell pressure. In quiet periods, the squeeze is harsher. So the same halving can produce very different price paths depending on network usage at the time. Now, liquidity. You will hear that halving causes a supply shock because fewer coins are created each day. True, but the tradable float depends on who is willing to sell. Exchange reserves, long-term holder behavior, and derivatives positioning can outweigh issuance. When long-term holders pull coins off exchanges, the market tightens and small buy orders move price disproportionately. When they send coins back, the effect fades. Watching those flows often tells you more than watching the calendar. Narrative amplifies everything. As Naval Ravikant likes to say, incentives drive outcomes. The halving creates a simple, repeatable story that aligns the incentives of miners, media, and momentum traders. Positive headlines attract demand, which validates the story and pulls in more. If confidence weakens or a security scare steals attention, the loop breaks. Here is another angle most ignore. The structure of derivatives shapes spot moves. Funding rates, options open interest, and the hedging of market makers can turn what should be a gentle grind into sharp squeezes. When issuance falls, it is easier for well-capitalized players to push price through thin areas, forcing liquidations and accelerating trends. Often the largest candles arrive after the halving, rather than on the day itself. So what actually changes for an investor? 3 levers matter. First, timing. Historically, the strongest advances have followed consolidation after the event, not the week of. Second, conviction. Volatility around miner stress can be designed to shake out weak hands. Third, selection. Assets most aligned with Bitcoin's monetary narrative tend to absorb new demand first before it trickles to riskier bets. One more force could make the next cycle look different. A growing share of coins changes hands in private over the counter markets instead of public exchanges. Those deals do not print on retail charts, yet they drain available supply or add it back when settlements hit. If large buyers accumulate quietly, the market can look sleepy until liquidity thins and price gaps higher. If large holders distribute through those channels, rallies can stall without obvious warning. Stay with me. Next, I will map a clear checklist for navigating halving cycles with less stress and more clarity, including 3 on-chain and market signals that often turn before price. Here is the checklist I promised, distilled from the cycles that came before. First, watch miner health. When the reward is cut, inefficient miners often shut down, difficulty eases, and the surviving operators sell fewer coins. Three early tells tend to flash before price trends. Hash rate stalls or dips for a short window, minor balances on chain decline as weak players liquidate, and the difficulty ribbon compresses, signaling stress giving way to recovery. When that stress resolves and hash rate resumes a smooth climb, the market often finds a durable floor. It is the moment when forced sellers are gone. Second, track the behavior of long-term holders. When coins older than several months stay off exchanges and coin days destroyed remains muted, supply tightens. If those older coins suddenly move to exchanges, the market is inviting a pause. One simple gauge is whether exchange reserves of Bitcoin are drifting lower while spot demand is steady. Falling reserves in the face of rising interest create a coiled spring. Rising reserves, when optimism is already high, often precede a shakeout. It is not perfect, but it consistently adds context that price alone cannot. Third, read liquidity and derivatives like a weather report. Negative or flat funding with steady spot buying is healthier than euphoric positive funding with everyone on the same side of the boat. Options dealers hedge flows, so a cluster of strikes just above spot can act like magnets during thin liquidity. When open interest is large relative to market size, small impulses create outsized moves. That is why the biggest candles often arrive after the halving, not on the day. The mechanics line up, then the narrative catches up. Now, how do you turn this into a plan you can actually follow? Start with a calm accumulation framework. Use a base schedule to dollar cost average, then layer small additions when two or more of those signals align. Minor stress easing, exchange reserves falling, and funding resetting toward neutral is a constructive trio. Size additions modestly and assume you will be early or late by a few weeks. Precision is less important than discipline. But here is the twist most investors miss. Liquidity is a weapon. Keep a slice of cash ready for thin Sunday nights or holiday sessions when order books are shallow. Place patient limit orders below obvious levels rather than chasing green candles. You will be surprised how often you get filled when an algorithm hunts stops. As Howard Marks likes to say, you do not have to swing at every pitch. In crypto, that patience is alpha. Risk comes next. Avoid high leverage during the months around a halving. If you insist on using derivatives, consider defined risk structures like call spreads instead of naked futures. Protect the downside first, then let the upside compound. Warren Buffett put it simply, do not risk what you have and need for what you do not have and do not need. In practice, that means keeping custody tight. As Andreas Antonopoulos reminds us, not your keys, not your coins. Use hardware wallets and avoid leaving core holdings on exchanges. What about rotating into other assets? Historically, flows concentrate in Bitcoin first, then spill into larger platforms and later into speculation. An investor-friendly approach is to let Bitcoin leadership confirm, then selectively add exposure to core infrastructure that directly benefits from network usage, such as scaling solutions or custody providers. Keep experiments small and time-bound. If the thesis does not play out, recycle capital back into strength. When should you de-risk? Watch for crowded positioning. If funding turns aggressively positive, options skew tilts toward calls, and long-term holders start distributing to exchanges. Consider scaling out of leverage and trimming trading positions. Notice, I did not say abandon a core allocation. The halving narrative spans years, not weeks. Your edge comes from holding a thesis through noise while managing risk with rules you wrote in calm moments. There is one more lever that could make the next cycle look different. Fees as a share of miner revenue may matter more over time. If on-chain activity grows and fees meaningfully supplement the shrinking subsidy, miner selling pressure could be lower than many models assume. If activity is quiet, pressure rises and shakeouts last longer. The path depends on usage, not the calendar. So, here is your simple playbook. Accumulate with discipline rather than prediction. Read miner health, holder behavior, and derivatives to time small adjustments. Keep cash for thin liquidity moments. Favor spot over leverage. Guard your keys. Let Bitcoin lead and be selective with everything else. Most of all, measure success by the quality of your decisions, not by guesses about short-term price. Satoshi designed a system where supply is known in advance and trust is minimized. Vitalik Buterin often warns that people overestimate what can change in a year and underestimate what can change in a decade. Apply that lens to the halving. The day itself is not the point. The discipline you build around it is. Stay curious, stay patient, and let the math of scarcity, demand, and time do the quiet work you hired it to do.